Silver alert. While you were sleeping, something happened in the silver market that hasn't occurred in human history. Not in 1980, not in 2011, not ever. The price you're seeing on your screen right now is not the price people are actually paying. In Dubai, silver is trading at $127 per ounce. In New York, the official price shows $73. The same metal, two different planets. And the gap is widening by the hour. What broke? And why the world's largest banks are now scrambling behind closed doors? Welcome to Currency Archive. If you've been in business long enough to remember when a handshake meant something, when contracts were built on trust, not legal clauses, then you understand that markets don't lie forever. We'd appreciate if you'd subscribe to this channel, not because we need the numbers, but because what's coming requires informed decision makers like yourself to be positioned correctly. And do us a favor, drop a comment below and tell us where you're watching from. Are you in the States, Europe, Asia? Because what we're about to show you is happening differently in every corner of the world, and your location might determine how this affects your portfolio. Now let's get into what's really happening. On a quiet Tuesday morning in January 2025, something unusual happened in the silver market. Traders in Dubai logged into their systems and saw silver trading at $127 per ounce. At the same moment, traders in New York saw $73 on their screens. The same metal, the same day, two completely different prices. This wasn't a glitch. This wasn't a temporary error that would fix itself in minutes. This was the beginning of something much larger, a fundamental breakdown in how silver has been priced for decades. For years, silver moved predictably across borders. When prices rose in Asia, they rose in America. When European dealers paid more, American dealers adjusted quickly. The difference between regions rarely exceeded a few dollars per ounce. Arbitrage traders made their living on these small gaps, buying low in one market and selling high in another. But in early 2025, that system stopped working. The gap between physical silver prices and paper silver prices grew from $5 to $15, then $20, then $30, then $50. By the time silver officially crossed $100 on exchange pricing, the real street price in physical markets had already blown past $120 in major trading hubs. Financial analysts called it a dislocation event. Veteran traders called it unprecedented. Business leaders quietly called their treasury departments and asked a simple question: how much silver exposure do we have? The numbers told a troubling story. At the COMEX exchange in New York, the official center for silver trading in North America, something wasn't adding up. The exchange showed massive open interest in silver contracts. Thousands of investors held paper claims to silver. But when analysts looked at the actual physical silver sitting in COMEX warehouses, the math became uncomfortable. There were far more claims than metal. In previous decades, this ratio stayed relatively stable. For every 100 ounces of paper claims, there might be 10 or 15 ounces of actual metal in storage. The system worked because most traders never asked for physical delivery. They settled in cash. They rolled contracts forward. They played the paper game. But in 2025, that started changing. Investors began demanding delivery. Industrial users who needed silver for manufacturing started pulling metal out of warehouses. And when they looked at inventory levels, they realized something disturbing. The cupboard was running bare. COMEX responded the way exchanges always respond when they feel pressure. They raised margin requirements. This meant traders had to put up more cash to hold the same positions. It was a clear message. We need fewer people asking for physical metal. But raising margins didn't stop the bleeding. It confirmed what many suspected. The exchange was worried about its ability to deliver. Meanwhile, across the Pacific, China made a quiet announcement that most Western media barely covered. New export restrictions on strategic metals. Silver made the list. For years, China had been one of the world's largest silver exporters. Chinese refineries processed ore from mines across Asia and South America. That silver flowed freely to global markets. It kept prices stable. It kept the arbitrage system functioning. When China tightened those export taps, something broke in the global supply chain. Dealers in Singapore reported difficulty sourcing metal. Buyers in Switzerland saw premiums spike. Even in India, where silver holds deep cultural importance, physical metal became harder to acquire at official prices. The fracture became visible to anyone paying attention. A businessman in Germany could look at silver prices on his computer screen and see 75 per ounce. But when he called his local dealer to actually buy silver bars, the quote came back at $115 per ounce. A $40 gap between paper and reality. This wasn't supposed to happen in modern markets. Information travels instantly. Money moves at the speed of electrons. Arbitrage traders are supposed to eliminate these gaps within minutes, not watch them grow for weeks. But arbitrage requires something fundamental: the ability to move metal from where it's cheap to where it's expensive. And that ability was disappearing. Export restrictions made it difficult. Shipping delays made it slow. Insurance costs made it expensive. And most importantly, Sellers in low-price regions stopped being willing to sell at low prices when they knew buyers elsewhere were paying double. Why would a refinery in Asia sell silver at $75 when they knew European buyers were desperate for metal at $120? They wouldn't. They held back. They waited. They renegotiated contracts. The market that had functioned smoothly for generations was fragmenting into regional islands, each with its own price, its own supply constraints, its own reality. Banks that had sold paper silver contracts began quietly reviewing their exposure. Mining companies that had hedged future production started calculating whether those hedges would bankrupt them if prices kept rising. Industrial manufacturers that relied on silver for electronics and solar panels began emergency meetings about supply security. And through it all, the price kept climbing. Silver crossed $100 officially, then $105, then $110. Each tick higher represented more than just numbers on a screen. It represented a system under stress, a market searching for a new equilibrium, and business leaders worldwide realizing they needed to make decisions quickly about something most had taken for granted for years. The metal that had quietly powered technology, finance, and industry was suddenly anything but quiet. There's an old rule in commodity markets that professionals have trusted for over a century. When a product costs less in Tokyo than it does in London, someone will buy it in Tokyo and sell it in London. The profit might be small, but it's reliable. Do it enough times, and those small profits add up. More importantly, this process keeps prices balanced across the world. Economists call this arbitrage. Traders call it easy money. In 2025, it stopped being easy, then it stopped being possible. The mechanism that kept silver prices aligned across continents didn't just slow down, it shattered completely. And when veteran traders tried to understand why, they discovered something that challenged everything they thought they knew about how markets work. A trading firm in Switzerland illustrates the problem perfectly. For 15 years, this firm made steady profits moving silver between markets. Their operation was simple and elegant. Buy silver in Dubai when prices dipped. Ship it to New York when prices rose. Pocket the difference. They employed analysts who watched price spreads minute by minute. They had logistics teams who knew every shipping route and customs procedure. In December 2024, they noticed the spread between Dubai and New York widening. Not unusual. Spreads fluctuate. That's the business. They bought silver in Dubai at $68 per ounce. They arranged shipping to New York, where prices showed $74. A $6 spread meant decent profit after costs. But when their silver arrived in New York 3 weeks later, something strange happened. Chinese customs held the shipment. New export documentation requirements. The delay stretched from days to weeks. By the time the metal cleared and reached New York, the price there had jumped to $89. Great news, right? Bigger profit? Except when they tried to execute the same trade again, Dubai sellers wouldn't sell at $68 anymore. They wanted $95. And Chinese export approvals that used to take 48 hours now took indefinitely. The arbitrage window didn't just close, someone welded it shut. This wasn't happening to one firm. This was happening to everyone who traded physical silver across borders. The implications went far deeper than traders losing a profit opportunity. For decades, the COMEX silver price served as the global reference point. When someone in Mumbai wanted to know silver's value, they checked COMEX. When a manufacturer in Berlin negotiated a supply contract, they referenced COMEX pricing plus a small premium. The system worked because arbitrage kept COMEX connected to physical reality. If COMEX prices drifted too far from actual supply and demand, traders would step in. They'd buy physical metal and sell COMEX contracts, or vice versa. This constant pressure kept paper prices honest, but in early 2025, that connection broke. COMEX showed silver at $73 per ounce. Meanwhile, actual transactions for physical metal were happening at $115s, $125, even $135 in some markets. A gap this large should have been impossible. Arbitrage traders should have eliminated it instantly. They tried, but they couldn't move metal. Export restrictions blocked them. Shipping delays frustrated them. And even when they could physically move silver, sellers in cheap markets refused to sell at cheap prices. Why accept $73 when you know buyers are desperate at $125s? This created a phenomenon that commodity markets rarely see: complete price discovery failure. Nobody knew what silver was really worth anymore. The official price meant nothing. The physical price varied wildly by location, and the gap between them kept growing. Financial analysts who studied the situation realized something unsettling. The COMEX price wasn't reflecting silver's value. It was reflecting the price of a promise, a contract claiming to represent silver, a piece of paper that might or might not ever convert to actual metal. Smart investors started asking an uncomfortable question. What happens when everyone holding these contracts asks for delivery at the same time? The math was brutal. COMEX had approximately 300 million ounces worth of open interest in silver contracts, but their registered warehouse inventory held only about 45 million ounces available for delivery, a ratio of nearly 7 to 1. In normal times, this doesn't matter. Most traders settle in cash. They don't want physical metal. They're just betting on price movements. But these weren't normal times. Industrial users needed actual silver. Electronics manufacturers couldn't build circuit boards with paper contracts. Solar panel producers couldn't use COMEX receipts in their factories. They needed metal. Investment demand was shifting too. Wealthy individuals and family offices were losing faith in paper claims. They wanted bars and vaults they could visit. They wanted metal they could touch. This created a quiet panic among the institutions that had sold these contracts. Banks that had confidently written silver derivatives suddenly faced the prospect of having to deliver metal they did not have, at prices that would bankrupt them if they tried to acquire it in physical markets. Mining companies that had sold forward production contracts looked at current prices and realized they had locked in losses that could destroy decades of profits. The system that everyone trusted was revealing itself to be far more fragile than anyone had imagined, and silver kept climbing. In a corporate boardroom in Munich, Germany, the CFO of a major electronics manufacturer asked a question that nobody could answer. How much will our costs increase if silver stays above $100? The procurement team shuffled papers. The finance director opened spreadsheets. The operations manager cleared his throat nervously. Nobody had a clean answer, because nobody had planned for this scenario. This company wasn't alone. Across industries and continents, executives were having versions of the same conversation. And what they discovered wasn't pleasant. Silver wasn't just another commodity line item on their balance sheets. It was embedded deep in their operations, their products, their entire cost structure. And most of them had never bothered to map just how exposed they really were. Take the solar panel industry as an example. Every solar panel contains silver, not much, maybe 20 grams per panel. At $20 per ounce, that silver cost about $13 per panel, barely noticeable in a product selling for $200. But at $120 per ounce, that same silver now costs $77 per panel. Suddenly, silver represented nearly 40% of manufacturing costs instead of 6%. Solar companies had built their entire business model around government subsidies and projected cost declines. Their profit margins were thin by design. They planned to make money through volume and efficiency improvements. A quadrupling of their primary raw material cost wasn't in anyone's business plan. Some solar manufacturers tried hedging earlier. They bought futures contracts locking in silver at lower prices. Smart move, right? Except those contracts were mostly paper settlements. And when they tried to actually take physical delivery to feed their factories, they ran into the same problem everyone else faced. Metal wasn't available at contract prices. Their hedges protected them on paper, but their production lines needed actual silver, and that was trading at street prices far above what their contracts promised. The electronics sector faced similar mathematics, just with different numbers. Smartphones, laptops, automotive electronics, medical devices all depend on silver for conductivity and reliability. The amounts per unit are small, but the volumes are massive. A smartphone manufacturer in South Korea did the calculation. They produced 200 million phones annually. Each phone contained roughly 0.3 grams of silver. At old prices, their annual silver cost was about $38 million. Manageable. At new prices, that jumped to $230 million and additional $192 million in costs, with nowhere to pass them along. Their contracts with retailers were already locked in. Their margins were already tight in a brutally competitive market. They couldn't absorb these costs, but they couldn't raise prices without losing market share. And they couldn't eliminate silver from their designs without years of re-engineering. They were trapped. Defense contractors discovered they had a different problem entirely. Silver isn't just useful in weapon systems and communication equipment. It's classified as a strategic material. National security depends on reliable access to it. A missile guidance system might only contain a few ounces of silver, but that silver must meet exact specifications. It must be traceable. It must be available when production schedules demand it. When one major defense contractor checked their supplier agreements, they found concerning language. Suppliers were obligated to deliver silver at contracted prices, subject to availability and force majeure conditions. That fine print suddenly mattered, because suppliers were starting to invoke those clauses. They couldn't source silver at the prices they'd promised. The contracts weren't worth the paper they were written on. Pentagon procurement officers began quiet conversations about strategic stockpiles and domestic production capacity. Questions that hadn't been relevant in decades were suddenly urgent again. Meanwhile, the financial services industry faced its own reckoning. Banks and investment firms had sold countless silver derivatives. Exchange-traded funds promised investors exposure to silver prices. Futures contracts obligated delivery. Options gave holders the right to demand metal. These products worked fine when silver was stable and available, when the price discovery mechanism functioned normally, when arbitrage kept paper and physical markets aligned. None of those conditions existed anymore. Fund managers who promised investors they held silver-backed assets discovered their storage costs skyrocketing as they tried to secure actual metal. Some funds had used unallocated silver, basically IOUs from bullion banks promising to deliver metal on request. Those IOUs were becoming increasingly difficult to convert to actual bars, and investors were starting to ask uncomfortable questions about what they actually owned. One hedge fund in Connecticut had built a sophisticated strategy around silver options. They'd sold puts, bought calls, created spreads that generated steady income when volatility stayed moderate. When silver went parabolic and the physical market disconnected from paper markets, their mathematical models stopped working. Counterparties couldn't deliver. Exchanges changed margin rules mid-game. Positions that looked hedged became catastrophically exposed. The fund's managing partner spent sleepless nights calculating whether they could survive until the market stabilized. But the most surprising developments came from unexpected corners of the business world. Small companies began appearing with focused missions: silver recovery from electronic waste, extraction from old solar panels, refining from industrial scrap that was previously too expensive to process. These weren't glamorous businesses, but they were suddenly extremely profitable. When new silver costs $120 per ounce, recovering it from scrap at $60 per ounce becomes attractive economics. Entrepreneurs recognized something that larger corporations were too slow to see. A structural shortage of physical silver meant opportunities all along the supply chain for anyone nimble enough to exploit them. Corporate treasurers who had ignored silver for years suddenly needed to become experts overnight. Their company's survival might depend on decisions they made in the next few months. About a metal, most had considered an afterthought, and the price kept climbing. In a private research note circulated among institutional clients, one of Wall Street's most conservative analysts wrote something that made readers pause. Silver at $150 per ounce is no longer a question of if, but when. This wasn't a newsletter trying to sell subscriptions. This wasn't a YouTube personality chasing clicks. This was a firm that managed $400 billion in assets, known for cautious forecasts and institutional credibility. They were calling for silver to double from already historic highs, and they weren't alone. By mid-January 2025, a consensus was forming among serious analysts. Not the promotional crowd that always predicts massive price spikes. Not the doom and gloom commentators who see crisis in everything. The establishment itself was revising decades of assumptions about where silver was headed. A Swiss banking research team published a 60-page analysis that examined silver through a lens most had ignored: geopolitical fragmentation. Their argument was simple but powerful. For 30 years, globalization had kept commodity markets integrated. Metal flowed freely across borders, prices stayed aligned, supply chains operated efficiently across continents. That era was ending. China's export restrictions on silver weren't temporary trade negotiation tactics. They were permanent strategic positioning. China had watched Western nations weaponize financial systems through sanctions. They saw how supply chain control became geopolitical leverage. Why would China allow unrestricted export of a metal essential to military technology, renewable energy, and electronics when relationships with Western powers were deteriorating? They wouldn't, and they weren't. The United States recognized this shift too, though more slowly. Congressional briefings that used to focus on oil and rare earth elements now included silver. Defense Department assessments of critical material vulnerabilities highlighted dependence on foreign silver refining. Politicians who couldn't tell silver from platinum 6 months ago were suddenly asking pointed questions about domestic production capacity. This wasn't happening in isolation. India was building strategic reserves. Middle Eastern sovereign wealth funds were acquiring physical metal. Even smaller nations were recognizing that commodities with genuine industrial necessity were assets worth controlling. The world was fragmenting into regional blocks, and each block wanted secured access to materials that mattered. Silver mattered more than most people realized, but geopolitics was only one driver pushing prices higher. The monetary dynamics were equally powerful, just less visible. Central banks had spent years insisting inflation was transitory. Then they insisted it was moderating. Then they stopped talking about it as much because the narrative wasn't working. Real interest rates, the actual return after accounting for inflation, remained negative in most major economies. This created a fundamental problem for anyone holding cash or bonds. Money was losing purchasing power faster than it earned interest. In this environment, hard assets became attractive. Gold caught attention first, because it always does. But silver offered something gold didn't: massive industrial demand, creating structural supply deficits. You couldn't eat gold, you couldn't build a solar panel with it, you couldn't manufacture electronics that required gold's specific properties. Silver was different. Industries needed it. And when investors competed with factories for the same limited supply, prices had only one direction to go. The Federal Reserve faced an impossible choice: raise interest rates high enough to truly combat inflation and risk destroying the economy, keep rates moderate, and watch inflation persist while hard assets soared. They chose the path of least immediate pain, which meant silver's monetary appeal remained intact. Family offices managing generational wealth were paying attention. These weren't day traders or speculators. These were groups managing billions for wealthy families who thought in decades, not quarters. Their analysts looked at silver's fundamentals and reached conclusions that differed sharply from their historical allocations. Where they might have held 2 or 3% of portfolios in precious metals, they were now considering 10 or 15%, not because they were greedy, because they were worried about everything else. Government bonds offered negative real returns. Stock markets traded at valuations that assumed perpetual growth. Real estate in major cities had priced out fundamental value decades ago. Silver represented something tangible in a world drowning in financial abstraction. Industry analysts tracking solar panel installation rates, electric vehicle production, and 5G infrastructure rollout all reached similar conclusions. Silver demand from these sectors alone would exceed total global mining output within 18 months. This wasn't speculation. This was math. Counting panels, counting vehicles, counting cell towers, then calculating how much silver each required. The numbers didn't balance. Demand exceeded supply by margins that couldn't be corrected quickly. You can't just open a new silver mine. They take years to develop, require massive capital, and depend on ore grades that are declining globally. Mining executives knew this, which is why they'd hedged so much future production. They thought they were being prudent, locking in attractive prices for silver they'd produce in coming years. Now those hedges looked catastrophic. Committing to deliver silver at 25 per ounce when market prices hit 125 meant mining at a loss. The more they produced, the more money they lost. Some companies began buying back hedges at enormous losses. Others negotiated with counterparties to restructure contracts. A few simply acknowledged they'd have to breach agreements and deal with legal consequences. The strategic timeline for business leaders became clear, even if uncomfortable. Short term, the next 3 months, meant securing immediate supply at whatever cost necessary. Companies that hesitated would face production stoppages. Assembly lines don't care about procurement budgets. They need materials or they stop. Medium term, 6 to 12 months, required fundamental reassessment of business models. Could products be redesigned to use less silver? Could alternative materials substitute in some applications? Could price increases be passed to customers? These weren't questions with easy answers, but they were questions that couldn't be avoided long term. Beyond 12 months, the landscape looked radically different from anything business leaders had prepared for. A world where silver traded at $200 per ounce wasn't a crisis scenario anymore. It was becoming the baseline assumption. Those who positioned correctly would thrive. Those who waited for prices to return to normal would discover that normal was not coming back. The metal that most had taken for granted was teaching an expensive lesson about assumptions, complacency, and the difference between paper wealth and physical reality.